Hey everyone, welcome back. Today we're jumping into a topic that sounds scary, but honestly, it's the backbone of every major company in India. Ind AS, Indian Accounting Standards. If you've ever looked at a balance sheet and felt your soul leaving your body, don't worry. This video is basically your survival guide. We're going to talk about what Ind AS is, why India switched to it, and how the whole system works. Let's get started. So first, what even is an accounting standard? Imagine two companies, Company A and Company B. Company A reports something like stuff sold 10 lakhs, stuff cold 2 lakhs. Like, what is stuff cold? Leftover samosas? No idea. That's why we need accounting standards. They're the rulebook that tells you what goes into the books, how to measure it, how to present it, and what details you must disclose. Basically, they make financial statements clean, comparable, and understandable, instead of looking like a mystery novel. So why did we need new standards? Simple. India's economy leveled up. The old standards, AS, were great for the 90s. But once things like derivatives, complex mergers, and fancy revenue models showed up, the old system just couldn't keep up. It was like trying to run Netflix on a Nokia 3310. Not happening. Plus, investors around the world wanted a common financial language. So in 2009, the G20, including India, said, let's all speak the same accounting language. That language is IFRS, created by the IASB. But here comes the twist. India didn't simply copy IFRS, nope. We chose convergence. Adoption means taking the rules exactly as they are. Convergence means we take the rules and add some Indian masala. So yes, Ind AS is basically IFRS with a little Desi flavor. How is an Ind AS actually created? It goes through a whole government-style relay race. 1. IASB issues a standard 2. ICAI drafts the Indian version 3. They ask for public comments 4. NFRA reviews it 5. MCA finally notifies it under the Companies Act by the time it reaches your exam paper. It has survived quite the journey. What does an Ind AS document look like? Don't panic. Every standard follows the same structure. Objective. Why it exists, scope. Who it applies to, main content. How it works, disclosures. The fine print. And here's a cheat code. If it's IAS1, Ind AS1. If it's IFRS1, add 100. Ind AS 101. Simple and logical. Who has to follow Ind AS? It happened in phases. For companies, Phase 1, 2016. Listed or unlisted companies with net worth 500 crore or more. Phase 2, 2017. All listed companies and unlisted ones between 250 to 500 crore, and the famous Hotel California rule. Once you enter Ind AS, you can never leave. Even if your net worth drops later, sorry, you're still in. For NBFCs 2018, net worth 500 crore plus 2019, listed below 500 crore or unlisted 250 to 500 crore, and the twist. NBFCs cannot voluntarily adopt Ind AS. You join only when you're told to. Banks and insurance companies, still pending, waiting for RBI and IRDA. Mutual funds, SEBI made it applicable from April 1st, 2023. Is Ind AS optional? Absolutely not. It is backed by the Companies Act 2013, Section 133. Government can notify standards, Section 129. Statements must show a true and fair view, Section 143. Auditors must check compliance, and companies using Ind AS follow Division 2 of Schedule 3. They prepare the balance sheet, P&L, with OCI, and the statement of changes in equity. Some important format changes. Ind AS is very particular. You must separate disputed and undisputed receivables. You must classify items as financial versus non-financial. You must split assets and liabilities into current versus non-current, even for long-term loans. Why all this effort? Because Ind AS brings transparency, global comparability. Better access to international capital investors finally trust the numbers they're reading. And that's the Ind AS blueprint. If this helped you, hit that like button and stay tuned. More accounting content without the pain is coming your way.